Welcome to Credit Basics, how to build, manage, and monitor your credit. If your screen is not loading, please refresh your screen. My name is Danielle Cook-Ferguson, Senior Marketing Specialist at the Congressional Federal Credit Union and moderator for today's presentation. Congressional Federal provides innovative and affordable financial products and services, education, and community outreach to the Congressional FCU family, which includes the House of Representatives, Congressional Support Offices, and functions on Capitol Hill, in addition to affinity and non-affinity select employment groups. Established on July 9, 1953 by 8 congressional employees with just $40 in deposits, we have grown to over 47,000 members and still counting. Congressional Federal has developed a reputation as a trusted credit union based on its proven track record of reliability with its members. Our presentation today will run about an hour, including time for questions and answers at the end of the presentation. Please feel free to enter your questions into the pod to the left of your main screen. I'll be collecting them for the Q&A period at the end. This presentation is being recorded, and an archive link will be emailed to you within the next couple of days. Today's presenter is Greg Jenkins, Consumer Lending Director at Congressional Federal Credit Union. Greg has over 17 years of experience in consumer lending management within the credit union industry, including experience in consumer credit finance, financial counseling, and portfolio management. He is committed to helping credit union members meet their lending needs and financial goals, and has been directing the Consumer Lending Department at Congressional Federal Credit Union since March 2015. And now I'll turn our presentation over to Greg.
Wonderful. Thank you, Danielle. Hello and welcome everyone to today's webinar on the topic of how to build, manage, and monitor your credit. Once again, my name is Greg Jenkins, Director of Consumer Lending here at Congressional Federal. Part of our mission as a credit union is to help you, our members, achieve financial independence. And understanding your credit is a fundamental building block of your financial success. So that's why we're here today. The information that we'll cover today on understanding your credit will be fundamental and basic in nature. It's really a credit 101 course, if you will. We will review the fundamental nuts and bolts of a credit report and provide some tools and tips to help you on your journey towards financial independence. Okay, let's get started. To begin, we'd like to conduct a poll of the audience. So you should be seeing on your screen here momentarily just a one-question poll. And go ahead and answer the question accordingly. The question is, when was the last time you checked your credit score? Less than 1 month ago, 2 to 6 months ago, 7 months to 1 year ago, more than 1 year ago, or never? So we'll give everyone a few moments just to submit your answers to the poll and see what we come up with. We have some results coming in. We'll give a few more moments. Okay, thank you very much. Looks like we had a couple of people that have checked their credit report less than 1 month ago, and that was the majority of the responses. Nobody selected more than a year ago or never, so that's fantastic. So we know that everyone is aware that their credit is out there. They're aware that it's something that we should be monitoring on a regular basis. Fantastic. Thank you very much for participating in that poll. The first thing we'd like to start with in the first section is, how does credit affect your life? We're going to talk a little bit about what a credit report is, what it is not, perhaps. What is the definition of a credit score, which affects all of us in our lives and the importance of that? And what are the sections of a credit report? So to begin, how does credit affect your life? Number one, it allows us to advance in life. And what do I mean by that? Whether we realize it or not, credit has a big impact in our long-term success financially and both personally as well. When we apply for a job or have a career or look for the next step in our career progression, very often our employers or employers that we're looking to work for pull our credit report. They're going to use that report to determine our credibility with paying our debts, our character, what sort of debts we have as far as are they highly indebted to others, and it really impacts our ability to get a job. So whether we realize it or not, we need to maintain very good credit so that we can progress in our job. And of course, having a job is very important to our financial stability, our family's health, safety, investing for the future. So very important in that respect. Many of you, I'm sure, know also that when you go to either rent an apartment or even rent a car or try to purchase a cell phone, they're going to pull your credit report. Again, they're going to look for how creditworthy are you. Are you someone that is likely to repay the debts or the contract that you are engaging in with that company? Also, when you go to purchase insurance, whether for home insurance, auto insurance, renter's insurance, another opportunity for those companies to pull your credit. When you buy a home or buy a car or get a credit card, of course, I think everyone knows that those lenders are going to look at your credit report to determine how much debt do you have, how do you repay others in the past, because past performance is a predictor of how you will potentially repay them in the future. So certainly everyone is looking at that when you apply for credit. So that's what I mean by advancing in life. You know, if we don't have a job, if we don't have a place to live, if we can't get insurance, it really affects our abilities to progress in life with our personal lives, our goals, and our families. The second thing that really impacts our abilities to advance in life is it determines the rates of interest that we pay. It can either hurt us if we're paying high interest on our debts, or it can really help us if we're paying very low interest on our debts. And there's a great opportunity cost that we give up when we pay high interest on our debts. Rather than paying a minimal amount of interest on our debts, if we're paying more, that is money that we could be used towards building a safety net, a 6-month safety net cushion in case we have emergencies in our lives. We can invest in our education and our children's education. We can use that money to invest in our future. We can even use that money to pay down the very debt that we have to our lives, which can help us be more financially stable, not be indebted so much. That helps us get future loans in the, when you don't have as much debt, it helps you get future loans at lower interest rates. So there's this whole snowball effect of having good credit and having it be able to help us financially as opposed to hurting us in the form of paying high interest. So what is a credit report? A credit report is nothing more than a centralized record of all of our financial dealings. It looks at our credit activity, looks at our history, and why do they even exist? Many years ago, when you went to a lender to get a loan, the lender would shake your hand, look you in the eye, look at your assets, call your friends, call your neighbors, get references on your character, and they would make a determination, basically, is this person in front of me likely or unlikely to repay this loan that they are asking for? And so it wasn't scientific. So one area that came about in society was credit reports, and it gave lenders and many other companies, as we've talked about before, like insurance companies, employers, it gave them the opportunity to look at this individual applying for something, a job, for credit, and know based on their past history how they might perform in the future. So that's the origin of credit reports, and credit reports are held by traditionally 3 main credit bureaus, of course, Equifax, TransUnion, and Experian. These are 3 companies that simply gather data from many different organizations, from lenders, from public records around the country, and they consolidate it in one report. And it is a snapshot of you financially. Each month, lenders report to these bureaus how you're repaying your debts. Are you paying late? How much debt do you have? How much new debt are you taking on? And it's just a repository of all of your financial information. So one of the questions I like to pose, rhetorical question to everyone, is who owns this data? Who's responsible for making sure it's correct? And the answer is you are. You have the ability to check the credit report. This is your information. It's our responsibility as consumers, as individuals, to make sure that it's accurate because no one else is really going to do it for you. And it's in everyone's best interest to do so for all the advantages we've talked about before. So, if you get anything out of this webinar today, I want to encourage you to take control of your credit report, take control of your life and your finances and everything that surrounds your credit report, because you have the ability to control it and make your destiny what you want it to be. The next section is what is the definition of a credit score? A credit score is simply something that the credit bureaus calculate. They take all the information in the credit report. They generally have a range between 300 and 850. The higher the credit score, the better. They will take into account many different areas of your credit report to come up with a credit score. They will take into account how you pay your bills. They will take into account how much debt you have. And it's just a numerical number that can define for lenders how we will assign risk to this potential borrower, what interest rates we will assign, and should we approve them or decline them based on their credit score range. So that is the definition of a credit score. What is in a credit report? There are a few different sections of a credit report, and we're going to go through those briefly today. The first area is what's known as the personal profile, or your identification information. Simply provides your name, your social security number, address, maybe former addresses if there are some, your current employer. Gives very basic information about who you are. The next section, typically in a credit report, is what's called the trade lines, also known as credit lines. So these are all the debts that you might have. These include your credit cards, your mortgages, your car loans, your lines of credit. What are all the debts that you have incurred, and how well do you pay them? It provides information about, are there late payments on those debts, 30 days late, 60 days late, 90 days late? Are those debts in good standing? When were they opened? When were they closed? And what's the current status? Were they charged off, meaning did that creditor take a loss on that debt? So a wealth of information is in the credit lines or the trade line section of a credit report. Another section of the credit report is credit inquiries. So whenever you apply for credit, the lender is typically going to pull your credit report. They are going to see what your credit looks like. And when they do that, it shows up on your credit report as an inquiry. That lender is inquiring into your credit. And once again, a credit bureau is simply a repository of all this information. So the credit bureaus sell that credit report to people that inquire on you. Finally, there are public records in credit reports. So these include things like bankruptcies, judgments, liens perhaps on your property, any unpaid tax liens, for example, could show up in that area, things that are of public record. Those are the basic statements of a credit report. What you might see, the basic sections of a credit report, what you might see in some others are personal statements. You have an opportunity as a consumer at the end to make a personal statement about anything on your credit report. So, for example, if you wanted to provide an explanation of a bankruptcy, it gives us as consumers the power and the right to do so that those that are pulling our credit and looking at us have an explanation of what might have happened that led to what they're seeing on that credit report. Credit scores often are included in the credit reports as well. Those are purchased from those that are ordering them. Some credit reports also have a summary of all your information. So it might summarize all your credit lines. It might take the aggregate amount of debts that you have, whether it's revolving debt, installment debt, and provide a snapshot for those looking at the credit report. So those are the sections of a credit report. As we go through the presentation, we're going to take a deeper dive into what are the components of the credit score. How is that actually calculated? And it's very much a mystery in the past. From time to time, we think, well, yes, we all have this score, but nobody really knows how it came about. So we're going to try to demystify that for you a bit. And in general, you can see in front of you that the biggest section of your credit report that affects your score is your payment history, and that's 35% of your score. So how you repay your debts is very important to your credit score, your credit worthiness. The next section is the amount that you owe. So that's the aggregate and total amount of debt that you owe. So if you have 3 credit cards with balances of $5,000 each, it's going to show that you owe $15,000 on your revolving credit, for example. Smaller sections that affect your score include the length of your credit history. So one of the components looks back and says, when did you start showing up in credit? When was your first loan? Was it 6 months ago, 6 years ago, 30 years ago? And obviously, the longer you have established credit, the better it is for your score. It affects 15% of that score component. The credit score also looks at the types of credit you have. A greater mix gives you a higher credit score in general. So someone that might have 5 credit cards and that's it might have a lower score in that section versus someone that has 5 credit cards, 3 car loans, 2 of which are paid off, 2 mortgages, 1 of which is paid off. And so that person has shown a very well-rounded mix of credit that they've been able to handle and manage through time. That's one of the areas that the score looks at. And finally, it does put emphasis on new credit accounts. So new credit accounts are those that are most active, those that are demonstrating for those that are looking at your credit report what this individual is doing currently as opposed to what they were doing 7, 10, 15 years ago. So that is how, in general, the credit bureaus calculate your credit score. So what resources can I use to establish credit? This question comes up a lot, especially for those that are just getting started on our credit life, whether we're young adults, whether we've had bankruptcies in the past, things we're trying to reestablish on our credit reports. And what I always tell folks is start with the most basic products. First of all, what you want to do is you want to make sure that all your past debts, if they are derogatory, are paid. Simply by having a charged-off loan or a charged-off credit card, what that tells the credit bureau is that someone had a debt in the past, they were not able to repay that debt, and it was charged off, meaning the lender took a loss on that. But that does not mean that you still don't owe that debt. So if we have the ability to go back, repay that debt, it will help reestablish our credit. For those of us that are just getting started in our credit lives, what I would recommend is a couple options, such as a share secured loan. Here at the credit union, we offer such a product whereby if you have money in your savings account, we can use that money as collateral for a loan. It's a guaranteed loan. You take out the money, repay it on time. The money in your savings account is always yours, and it allows you to reestablish or establish credit at any time as you repay that debt. We all know that we get a lot of offers through the mail on credit cards or in our emails. Credit cards are notorious for the ease of entry to credit. What I would say is that if you are certainly looking to establish credit, a credit card is a good way to go, as long as you understand the pitfalls and the benefits of owning a credit card. We might talk a little bit more about that later in this webinar, but those are 2 of the main products that we can use to establish our credit. And one of the things that are on credit reports that I wanted to mention that affect our ability to get credit is, again, that length of time. So we want to be able to establish credit, keep those accounts open, establish a length of time that we're showing that we're credit worthy, we can repay these debts, and that will, again, go a long way into establishing us as credit worthiness. So what are some of the do's and don'ts to build credit? Missing a payment is certainly something we never want to do. Again, we talk about the derogatory payments that people see on the credit reports. That's one of the biggest areas of your credit score. So we do not ever want to miss a payment. Closing old accounts. This is an interesting one. I often hear, well, I've got this old account, I've got this credit card, I've had it for 20 years. I really don't use it anymore. Should I close it? And the answer is, it depends. You might find that closing that old account may reduce the length of credit history on your profile. So you might want to consider using that card if there are some benefits to the card. You might want to look at that interest rate, determine that maybe it's a lower interest rate versus some of the other current cards that you're using. But just know that closing old accounts, while not the end of the world, can also have some benefits. It can help you clean up and manage the amount of debts you have. If we have the ability to manage less accounts, it might make our financial lives easier. But do know that it has a small impact into your credit score. Going over the limit. Generally, this is a don't. Going over the limit on a line of credit or a credit card is something that is a big red flag for lenders. What that tells lenders is that you are using credit to perhaps use it for lifestyle changes, using it for supporting your lifestyle, using it to pay bills. It's a level of risk that typically lenders do not want to see when they're looking at a credit report. So going over your limit affects your credit score as well. One of the areas of your credit score that is highly looked at is the amount of debt you have in relation to your credit limits. So, for example, if you have a credit card with a limit of $10,000 and you have a balance on that credit card of $2,000, you have a 20% ratio of debt in relation to that limit. What the credit bureau does is it takes all your aggregate balances and all your aggregate limits, and it calculates that ratio. So you want to be under 20% with that ratio. Anything over 20%, you start to see a reduction in your credit score, and lenders start to look at that and say, hey, there's a lot of red flags here. This person is relying on too much credit to manage their life. We'd like to see a much lower level of debt in relation to your limits. So in order to build a higher score, the recommendation certainly is to keep your balances very low in relation to all of your aggregate limits. Let's talk about old derogatory accounts. Again, we mentioned this briefly in the past. You want to go back and look at your credit report, and you want to find out what's on there. Because number one, you may have an old derogatory account that you know about. You may say, yes, I remember 10 years ago or 5 years ago when I was going through that financial hardship and I did not repay that car loan. And that's fine. You have the opportunity now to go back and try to clean that up and show that as a zero balance as opposed to a unresolved charged off account. Secondly, there might be derogatory accounts on your credit bureau that you don't even know about. There might be mistakes. And checking the credit report periodically gives you the opportunity to go back and remove those derogatory accounts. The removal of those accounts will greatly improve your credit score, increasing your ability to advance in life and do all the things you need. So that's a big one that you want to take particular attention to, is taking a look at what's on your account that's derogatory. And we mentioned having discrepancies. We're going to talk a little bit about how we can minimize those discrepancies and give you some resources and tips for how we can do that. Let's talk about some common credit myths and misconceptions. Checking your credit score, checking your credit drops your score. This is something that I get asked all the time, and it depends. If you are applying for credit, the credit bureau will provide to the lender what's called a hard inquiry. And a hard inquiry can affect your score. It's very minimal. There's no preset number of points that it affects your score because those scores are proprietary. But just know that if you're applying for credit all over town, each time you do that, you might see a very slight reduction in your credit score. Many times when we get offers for insurance or credit cards or offers in the mail, they do what's called a soft inquiry onto your credit. And what that means is that they are looking at your credit report, but they are not doing it in a manner that will affect your credit score. So there are two types of inquiries that can be done. Some affect your credit score and some do not. Just know that when you are initiating that check, it's something that can have a slight impact on your credit score. Closing old accounts increases your credit score. Again, we talked a little bit about that. You want to be wary of the fact that closing old accounts might reduce your time in the credit bureaus. So that's a common myth that doesn't necessarily hold true. Paying off negative records removes them from your credit report. Again, a myth. Paying them off is fantastic. It shows that you have responsibly gone back and cleaned up your financial responsibilities, but it doesn't remove them completely. Items will remain on your credit report for typically 7 years. If you have a bankruptcy, it's 10 years. And so what it does is designed to show a history of all your financial dealings. So once something's paid off, you still want to show that on your report to show that, yes, I've been able to repay that debt. It's there. It's something that shows my history, but it does not instantly remove it from your credit report. Good question I hear all the time from applicants is, co-signing means you're not responsible for the account. Or, oh, well, I don't really have to pay that debt. My son is paying it. I'm just a co-signer. That's a myth and a misconception. When you are co-signing and signing your name to any debt, any car loan, any credit card, any mortgage, any student loan, you are signing to the fact that you are financially responsible for that debt. Very often what lenders do is they will, if they need to collect on that debt, they will seek the primary applicant and borrower first, and they will come to you second. So please know that co-signing means that you are responsible for that debt. And what happens, unfortunately, from time to time is when we co-sign for our family members or our friends or our neighbors or our brothers and sisters, we don't really monitor that debt as much either because we assume that they are making those payments. Well, guess what? If they don't, or if they're going through a financial hardship, it's affecting your credit as well. So, you know, I caution folks to really think twice about co-signing for a debt. It's a great thing to do for friends and family if you can, but just know that there are real responsibilities behind that that could affect you greatly. Paying off debt boosts your score by 50 points. A myth and a misconception, yes, there's no hard and fast rule for how many points paying off a debt provides, and that is because as we looked at the makeup of a credit score, there's a lot of combinations that go into your credit score. So certainly paying off debt can improve your score. It can show financial responsibility, but there's no set fixed amount of points that it provides. And moving credit balances around will help hide any debt. Not true. That's a myth. As a lender, what we often look for is how much debt does one person have, and when are they opening and closing accounts. We can tell when someone is getting a debt on one account and opening a new account and bringing that debt over to the new account. So moving debt around doesn't necessarily change the amount of debt you owe in aggregate. It doesn't hide a thing. So just be careful about that myth and misconception. Having good credit comes from having credit cards and never using them. That's a common myth because the whole point of credit is to be able to establish a debt, use it, and demonstrate to the world that you can manage it. Very often I've heard from folks that say, you know, I'm a cash user. I don't want to take on much debt, and therefore my credit must be perfect. I'm a great credit risk because I don't take on a lot of debt. Or I have a few credit cards, and that's all that's on my credit report, and I'm financially responsible because I never use them. That can be true, but that can also be a myth because in order to establish credit, what you're trying to do is you're trying to establish to the world that I have the ability to take on debt and I have the ability through time to demonstrate that I can repay those debts. And so to establish good credit, you got to use it, you got to show that you can pay it off. Every lender wants to know from before the time of credit bureaus, even through today, that the bottom line is, do I believe that that person in front of me is going to repay this debt if I give them a loan? So we looked at that information to see how you've done in the past. So having good credit and never using your credit cards is certainly a misconception. One other area I wanted to share about myths and misconceptions is what's not on the credit report. It's something I just want to add to the screen here. Some people come to me and say, well, you know, what about my salary? Can you see that on my credit report? Not necessarily. The salary is not specifically mentioned as a section of your credit report. It can be deduced from your level of debts and how you manage your debts. But other things that aren't necessarily on there are things like your ethnicity, your marital status, your utility bills typically are not on there unless you don't pay them. So a good myth and misconception is that, you know what, I pay my utility bills on time, I'm building good credit, I paid my electricity bill, my internet bill, my phone bill, my water bill. Because those are not debts that you've incurred with specific terms under a contract, meaning I will pay you $300 a month for this debt, it doesn't show up as a contracted debt. They don't know how much water you're going to use until the month is over, and then they bill you for that water. So those do not show up unless you don't pay them, in which case they can turn it into a public record or a judgment against you in the courts, and those are really bad derogatory items on your credit report. So I just wanted to share as well some things that are not on the credit report but can be very important to your credit health. As we move on, I just wanted to pause and see if we could take a look at other ways to avoid credit card debt. So very important in our credit lives is how financially stable we are. What do we do when unexpected expenses arise, like health issues, job issues, unemployment, layoffs? Many, many things can happen in our lives that we can't expect. And it's very important for us to maintain our credit by having a financial cushion. So experts, you'll hear many times, will say it's important that we have at least 6 months of safety cushion in our savings account. And what does that mean? What I would say about that is that what we should do is we should add up all of our debts we need to live on, pay our rent, pay our mortgage, pay our car loan, pay our utilities. And what is that total amount? And that is the amount each month that we would want to save up for so that if something were to happen for a 6-month period of time, we would have a cushion. And why is that important? Number one, we're able to obviously continue our lifestyle, continue to have our electricity, our homes. But it's also very important so that we're not relying on our credit cards, our limits. We're not letting our credit reports suffer in a way that could really hurt us long term. So we certainly recommend having some resources in place before the unexpected expenses arise. Some other ways you can have some things in place are having a line of credit with your credit union, having revolving line of credit that you can tap into whenever you need it can be very important to your financial stability. Setting up a budget certainly is something that can help us manage our credit, because when we know what our expenses are, we can identify areas to bring down our debt and be more responsible and more efficient with our finances. So the point is, you don't want to wait for an unexpected expense to arise to think, hey, how is this going to affect my finances? How is this going to affect my financial life and my credit report? If we can plan ahead, we'll be that much more ahead. So in summary, what have we learned today? Number one, we want to make sure that everyone knows that we can take control of our credit. We've talked about the importance of good credit. We've talked about how it affects our lives, from our education, our ability to have a home, have a car, have a good career. And we talked about the sections of a credit report. Knowing what affects your credit score is very important in taking control of your credit. And once again, I just want to share that you are in control of the information on your credit report. Take it upon yourself to look at your credit report, find out what's good, what's correct, what might need a discrepancy to be fixed, and that will allow you to really take control of your financial life and your credit. We've talked about the do's and don'ts of building a credit score and how we can plan ahead for financial security. Some resources that we have available that we wanted to share either through the credit union or in today's webinar are on your screen now. The credit union actually participates with a financial counseling service called Balance, and you can see on our website a link to Balance. Also, their website is balancepro.org. And as a member of Congressional Federal, this is a free service to you. This is one of the benefits you have from being a member of our credit union. And what they do is you can give them a call or you can contact Balance. They can look at your credit report. They can identify areas that could be improved upon. They can help you with financial counseling. They can help you provide a budget. And that is something that we refer to our members to all the time to help them with their financial lives. AnnualCreditReport.com is a public resource for all consumers. This is the place you can go to request your credit report once a year from all three of the major credit bureaus. Again, we've talked about looking at your credit report, taking control of your finances, finding out what needs to be fixed. This is the place that you would go to do that. We also have many other resources on our website, congressionalfcu.org, or you can always call us at speak to one of our representatives at 1-800-491-2328. We would love to hear from you, find out how we can help you with your financial life, whether it's from cleaning up your credit report to loans, products, and services that we offer. So many resources available to you as a member of our credit union. So I want to thank you very much for the content that we've been able to provide today. I want to thank you for the opportunity for myself to be here and provide the webinar on how to build healthy credit.
Thank you so much, Greg. So I just pulled up the Q&A pod. This is now your chance to ask any questions that you may have about the presentation. I will now go ahead and start asking questions, but again, if you have any additional questions, please go ahead and enter them into the pod. So the first question we have here is, what are some common mistakes you have seen people make with their credit?
Great question. Again, number one, not knowing what's on your credit report. Very common mistake. People make assumptions about what's on there and what's not on there. That's number one. Number two, thinking that old information doesn't reflect what's happening now. As a lender, what we're looking at is what's happening now as well as what you've done in the past. So it's very important to go back and clean up what's on your credit report. And number three, I would say, as we mentioned before, assuming that not really using credit is a way to establish credit, that's a myth. The mistake would be to not have enough credit to get approved for loans, get approved for what you're trying to accomplish. Very common that I've seen, especially with those that are starting out, is to get that credit established so that they can get loans that they need and progress in life.
Great. The next question is, why is there more than one credit reporting agency, and is the information they collect the same?
Great question. The credit bureau agencies are individual companies. They are companies that are for-profit. They are out there to be a repository for your information. Again, they sell your credit reports to other lenders, other companies. So this is a free enterprise, and there happen to be three at the moment. The information on the credit bureaus can be different. Many lenders report to all three of the bureaus for the status of your loans and accounts. Some may not. Some may report to one or two. So it is important that we check all three of them to make sure that all the information that's reported to any or all three is accurate.
So when I apply for a credit card or a loan, what does the lender look for?
Great question. As a lender, our job is to find out what are your financial patterns. Is this person likely to repay the debt that they are requesting? We're going to look at how much debt you have. We're going to look at your income in relation to that debt. We're going to look at how you've repaid debts in the past. And we're going to try to come up with a pattern. Is this person moving up financially? Are they becoming more stable, or are they becoming less stable? And the way we look at your credit report to determine that is we will see how many new accounts you've opened recently, how much new debt have you taken on, and that might be a big red flag for the lender. So in general, those are the patterns and the information that we're looking for to make determinations on loans.
So Greg, I know you mentioned earlier in the presentation that co-signing on a loan could potentially harm your credit. So what are some steps you can take to improve your credit if the damage was already done by someone else?
Great question. We've talked about the importance of understanding what it means to be a co-signer, and that other person paying that debt is affecting your report every month. The first thing I would do is make sure that I'm having a conversation with the person that I engaged in that obligation with, and make sure I understand what it is going on in their life that's affecting their ability to repay this debt. Make sure I understand what might be coming for me. In other words, do I have to repay this debt if they're not able to? What's my financial cushion looking like? And that would be number one. Number two, certainly go back and make sure if the debt has been repaid or if it's been charged off. If there are any derogatory items on that account that are incorrect, you would want to dispute those through the annualcreditreport.com process. And that's a simple dispute process where you state what you think really happened. The credit bureaus will go back and work with that lender to say, hey, is this correct or is it accurate? And it can be cleaned up in many ways during that process.
So if your credit has been affected, how long does it take to improve your credit score?
Great question. There's no hard and fast answer to that because, again, the credit score is a combination of so many different factors that get updated monthly. In general, what I would focus on are the tips and tools that we provided today that can help you in each of those sections improve your score. Some things can happen overnight. For example, if you have a large balance of revolving debt in relation to your limits, and you're able to reduce that proportion very quickly or overnight, that section of your credit score and that credit score component will change that month. It will change very quickly. Many other areas can't change as fast, like old derogatory accounts, if they were accurate. Those will fall off eventually, again, 7 to 10 years. It's designed to show a history of all your financial dealings, so some of those do take time. But I would say work on reducing your debt, reducing your credit balances in relation to your limits, resolving any discrepancies, and those will have the biggest, most immediate impact onto your credit report and your credit score.
Wonderful. So I don't see any more questions in the Q&A pod, but if you do think of any additional questions, please do not hesitate to contact us. Our resources are listed here. So that concludes our webinar. I want to thank Greg again for being our speaker and doing such a wonderful job with explaining all of these wonderful tips to us. That concludes our presentation. An archive link of the presentation will be sent to you in a couple of days. In the meantime, again, if you have any questions, please contact us. And I want to thank you all for your time and participation. Thanks so much.